Hey everyone, Steve Schlueter, Market Stats and MOFIRS on a Friday. Hey, we're going to do something a little different today. We're going to look at economics, and we're going to explore why we may not see sub 4.5 interest rates again anytime real soon. And you're going, well, what? Isn't it kind of normal to be 3 or 4? No, it's not. And why were we so low for so long? Well, you hear this thing called the Consumer Price Index, and it's what's really the measure of what the consumer is doing, how much prices are going up, and that's driven, by demand. It's also driven by supply. We've had supply chain issues, and why was inflation under control for so long? Why is it rearing its head, and why is it going to be tough to get rid of? And it's a little thing called the consumer. And I want to share something with you that Gary Keller, when I was a team leader for Gary, had us really study economics, and particularly Harry Dent at a certain point. And Harry Dent, it's like most economists, he's hit it on some marks, he's missed it on others. Yet one thing that really is sound in his research is the impact of demographics. And when he talked about the consumer and consumer spending, he said, the peak spending year for the consumer is between the ages of 46 to 52, he's saying these days. And, that's as we go through household formation, where earnings are going up, spending's going up. And then once we get the kids kind of done, raised, we go into, empty nester stage, and we're putting more of our dollars into investments, into retirement, rather than consuming products and services at a much more accelerated rate. We're starting to decline some of those resources. And of course, as we get into retirement, that really goes down. Now, this is the thing to watch. Okay, so if we're talking about the consumer's peak in terms of spending is 46 to 50 or 52, well, where are those population patterns of people between those ages? So if we look at this birth rate cycle, why did we have such a crazy 2000s other than a couple of circumstantial recessions? Because we had a big consumer base. The baby boomer was spending a lot of money, and yet the baby boomer peaked out in their spending in 2012. And then you'll notice that after the boomer, the population gets a little thinner. So we had fewer people in peak spending years driving, thus not driving inflation at a high level. Consumption was getting moderated. And now the Gen Xers, they were the last ones were born in 1980. The Gen Xers today, they peak in 2028. They're done in 2028. And yet we look at this millennial generation. Now they're going to peak. They peaked in terms of their birth cycle somewhere around 1992. And yet when we take this and we use Dent's principles, this point, 1992, you lag that out 48 years. And this group won't be in their peak spending years till 2040. And likewise, these groups just before it. So between 2030 and 2040, 2042, we've got a really healthy consumer base that's still spending lots of money, still consuming at a high level. And so how does that play out? Well, it plays out like this. So Dent's work, now, by the way, he said, what's the real Dow when you take out inflation adjustment? And how has that followed the peak spending cycle? So this blue is birth cycles lagged 48 years. And so this group that's peaking right here was born 48 years ago. And you notice how the Dow Jones followed birth cycles pretty closely. Now it blipped here because we had a thing called the dot-com bubble that busted. And then we get into recovery, and we're starting coming back up, to match the spenders. And then we had the Great Recession due to bad economic decisions, lending practices. And then the consumer got really active as we rebounded and stimulated the economy and got up here. And of course, now they're adjusting down. But if you look, when that boomer peaked somewhere here in the 2012 range, less and less pressure on consumption. we had a lot fewer people in their peak spending years. And so it wasn't putting as much pressure on inflation. Now, where do we stand today? Well, if you look here, we're kind of in this trough, and yet the consumer is pretty active. And it's about to get really more active as we move beyond 2023, which means we already have supply chain issues. We have a consumer that is getting into their peak spending years, and that group is just going to grow and grow and grow and not peak out to 2040 and then slowly decline, not a huge decline. So I don't know that we're going to see a long-term trend of really low interest rates. So it's important to just kind of grasp this. The consumer is the thing that drives 70% of our economy. That's why they talk about, again, the consumer price index, because it's the impact of the consumer buying products that's been driving that up. And it's being hard to tame because there's still a lot of resources out there being spent and a lot of demand and, again, shortages of supply, making this tough to tame. So there's a little economics 101. We've got a consumer pattern coming down the road that is going to make it tough to tap down inflation because they're going to be in their peak spending years. And that consumer spending is what drives the economy. And with that pattern and a consumer that's ready to spend, it's going to be tough to bring us down to a 2% inflation rate, which would be the target, and would get then, of course, interest rates much lower. So trust this helps. Now, what becomes the message here? I don't think you turn this into a marketing piece. It's too complicated. The way you might use this as you begin to understand this is this could be good consult for a would-be buyer. Somebody's having a strategy session and they're going, well, I'll just wait till interest rates get down to 3%. Again, well, it may not, and here's why. And by the way, because you have a consumer coming into their peak spending years, a lot of them, the demand on housing that's going to continue is pretty tremendous. And we've had supply shortages of housing now for a decade. That this would suggest that that's going to be an ongoing concern. And all this would be part of my counsel for somebody making a decision today. And of course, real estate's local. There's nothing national about it. So what are migration patterns into your market? Are people moving out of your market, into your market? That comes into play too. So trust that's helpful. I know it's a lot. Drink some wine, have a beer, relax, meditate on this one for a little bit. See ya. Bye.